Well, good morning to you. Tony Virtue speaking, Virtue and Partners, with our regular monthly update. Primarily focusing on the budget last night and look in context. The Australian equity market hit a new all-time high a couple of days ago. Our property market is similar. Interest rates are at all-time low, and we have an extraordinary stimulus budget last night from the coalition. Details obviously are regularly available. I won't go into too much detail here now, except to give you the main macro things to be clear about. The primary goal of the budget was to aim at getting unemployment down to 4.5%. That's a courageous number, and we are seeing labour shortages coming into the market at the moment. Until that happens, interest rates will stay low. It does mean that it's a bit of a free kick for those of you who have assets. As I put in my notes, it's a lot easier to make money now with assets going up in value rather than the old-fashioned way of working hard, saving a bit of money and leaving it in the bank. As that becomes clearer and clearer to the public, well, then that almost becomes a self-fulfilling set of circumstance. In the markets, all of the major banks have reported much improved numbers in the last few days and improved dividends. Beginning to see quite a lot of takeovers happening as well. So Star's made a bid for Crown, Channel 7 for Boral, in our sector, Dexus for APN. And you should expect quite a lot of takeovers with interest rates being very, very low, and obviously the value of companies going up as well. Specifically in the budget, quite a lot for superannuation. You'll be able to put a little bit more money in, 27,500 work-related. Those of you in retirement phase goes up from 1.6 to 1.7, which will be helpful. And just some tinkering as far as lower balances as well that will now mean that there'll need to be superannuation paid. Probably most important of all, the 9.5% goes up to 10%. SGC with the intention to go up to 12%. This is a huge free kick for the sector. Effectively means there'll be a third more assets there to manage. It does mean that there'll be a greater push towards building up these superannuation balances. In part, that will be supported by the capacity for people over 60 now rather than 65 to downsize and put another $300,000 each into super, irrespective of their current balance. So again, that's quite a free kick. And for those able to do that, once we're getting into balances above $1 million, it does mean that we're drawing $50,000, $60,000 a year down tax-free, without really drawing on capital, and much of that can be achieved now with dividend yield from banks pushing up again into this 5-6%, and franking credits remaining the same. So look, it's pretty much a good news story for those in work at the moment, for those who've got the confidence to back themselves, maybe take on a little bit of debt when it's very, very cheap, and build their asset base. Quite a lot for aged care and those that are in need, so it's not just purely a financial budget, if I can say that. It really does impact for our community. It does also mean in the practice we're going to be very, very busy, so we're going to do a webinar in a couple of weeks. There'll also be the office open right through June, very long hours to help everybody through this. So so far so good. Do expect there'll be a downturn 5-10% in the equity markets. That's quite normal. We'll take it in our stride, and just shows that it manages speculation. Do understand that if markets get too strong, then interest rates will eventually rise, and markets will try and double guess this, and we'll have this usual game of tick, if I can say, before we actually get an outcome there. That's enough for this week, and I'll see you again before year end. Thank you, Tony.